Imagine this, you load 2000 rupees in your Starbucks app and planning to grab a few lattes over the next few weeks. But here's the catch. The money doesn't sit idle. It becomes part of a massive pool of prepaid funds that Starbucks holds, interest-free. This pool, often exceeding $1.7 billion at any given moment, acts like a secret interest-free loan from customers to Starbucks. Starbucks receives cash before it delivers a product. It uses that float to operate, earn returns, and even recognize pure profit from unredeemed balances. Hi everyone, today we dive into the world of Starbucks' stored value system, a hybrid of loyalty, fintech, and a retail brilliance. Back in 2001, Starbucks did something unusual. It launched a reloadable gift card. At the time, most gift cards were disposable, a holiday gimmick, but Starbucks saw something more, a way to keep customers locked into its ecosystem. The response, instant buzz. And within just 8 months, 4 million cards were activated. It was a clear sign that people were happy to prepay for their caffeine fix. Then Starbucks layered on more value. In 2008, it introduced Starbucks Card Rewards, early loyalty incentives for card users. By 2009, it merged loyalty into a unified app experience, My Starbucks Rewards. Time payments, rewards, and identity into one interface. The same year, it launched Starbucks mobile app, a game changer that made it easy to reload funds, track stars, and pay without cash or cards. From that moment on, every reload became more than just a payment. It became a data point, a marketing signal, and a micro loan. The question is, where does this all money go? When you load 1000 rupees to the app, Starbucks doesn't count it as revenue immediately. Instead, it becomes a liability on the balance sheet, technically called deferred revenue. It only becomes actual sales once you redeem it, say on a cold brew. Every time someone loads money into the Starbucks app or buys a gift card, it adds to the float. Here's what that looks like on an annual basis. In FY 2022, $13.46 billion was loaded. In FY 2023, $14.92 billion was loaded. In FY 2024, over $15 billion was likely loaded. This isn't revenue, it's prepaid cash that Starbucks holds upfront. Most gets used, but a small portion doesn't. That unspent amount is called breakage, pure profit. Here's how much breakage they've recognized as pure profit in recent years. FY 2021, $181.1 million. FY 2022, $212.7 million. FY 2023, $215 million. FY 2024, $208 million. There's no cost attached, making it nearly 100% margin. The question is, does Starbucks earn interest on all this money? The answer is yes. Though they don't always disclose the exact numbers. But back in FY 2016, Starbucks earned $21 million in interest income from its float. That was with much lower interest rates. Today, with higher interest rates and a bigger float, analysts believe Starbucks likely earns tens of millions more, quietly behind the scenes. But why does this matter to Starbucks financially? Think about this. Instead of borrowing from banks or issuing debt, Starbucks gets billions in advance from customers. There's no interest, there's no repayment timeline, just a large revolving pool of capital. No doubt it improves cash flow, reduces the need for external loans, and helps fund store operations and expansion, all before delivering a single coffee. And you know what? This even shortens cash conversion cycle because it already has cash on hand, much faster. But the question is, does it help with the customer loyalty too? The answer is yes, in a big way. When you preload 2000 rupees on the Starbucks app, you're not just funding future purchases, you're locking yourself into their ecosystem. You earn 2 stars per $1 if you pay using Starbucks card or app. You earn only 1 star per $1 if you use a regular credit or debit card. That reward gap nudges you to keep your money inside the Starbucks loop. And it works. In Q1 FY 2024, Starbucks hit 34.3 million active US rewards members, up 13% year on year. These members drove 55% of US revenue. Over 30% of transactions came via mobile order or payment. The question is, why is this model not just working in US, but in China, India, and Japan too. Because it hits the perfect mix of convenience, loyalty, psychology, and margins. Convenience because mobile ordering saves time. Loyalty because prepaid users earn better rewards. Psychology because customers feel invested in Starbucks once they've loaded the app. And margins because Starbucks pay fewer fees and collects data globally. At first glance, Starbucks app may look like a digital wallet. Why? Because you preload money, use it to pay, and earn rewards. But structurally, it's very different from traditional fintech payment systems. Let's walk through 4 different systems. First, we have traditional banks. These are the oldest and most regulated players in the game. Banks take your deposits, whether it's your salary, savings, or business income, and in return, they offer services like loans, cards, and sometimes a bit of interest on your savings. But they can't just do whatever they want with your money. They are required by law to hold a certain percentage in reserve, follow strict capital regulations, and maintain customer protections like deposit insurance, FDIC in the US or DICGC in India. They make money through lending, investments, and transaction fees, but everything is watched and governed by safety and trust. Banks are safe, but slow, expensive to run, and heavily constrained. Next, let's talk about Apple Pay and Google Pay. These are known as open loop systems. That means they don't hold your money. Instead, they act like digital messengers, securely passing your payment from your bank or credit card to the store. They rely entirely on existing banking infrastructure, like Visa, MasterCard, or UPI in India. So every time you pay with these apps, the merchant, let's say Starbucks, still pays 1 to 3% interchange fees to banks or card networks. And here's the thing, Apple or Google doesn't earn much from this, unless they are also issuing their own cards, like the Apple Card. So while it's incredibly convenient and secure for users, it's not a big moneymaker for the platform itself. Then comes PayPal and Venmo. These apps do hold your money. They are called closed loop wallets. When someone sends you money or you load funds into your PayPal account, the money sits inside the platform until you decide to use it or withdraw it. PayPal and Venmo have to follow financial regulations. They are licensed as money transmitters and must keep your funds safe. They don't pay you interest, but they can earn interest on the float. They also make money by charging fees on transactions, taking a cut from merchants, and even offering lending products like buy now, pay later. So while they are not full banks, they behave like mini fintech banks, earning real revenue from user balances and financial services. Finally, we have Starbucks app, and this one's totally genius. The Starbucks app looks like a simple loyalty program with mobile payments, but behind the scenes, it's one of the smartest financial plays in retail. When you preload money into the Starbucks app, they hold that money just like a wallet. But unlike PayPal, they are not regulated as a bank. They don't pay you interest, they don't hold reserves, and best of all, they don't pay card processing fees because everything happens inside their own ecosystem, inside their own system. So Starbucks wins in 3 big ways. They get your money in advance before you even buy coffee. If you don't spend the full amount, they keep the leftovers, pure profit. And last, they save on every transaction by avoiding Visa and MasterCard fees. And here's the twist. If Starbucks ever went bankrupt, your balance is not insured. You are just an unsecured creditor. So in a way, you've given Starbucks a free loan and they thank you with stars and points. In short, Starbucks isn't a bank, but it enjoys many financial benefits of one without the burden of regulation. It's not just selling lattes anymore. It's raising capital and building loyalty, one prepaid cup at a time. And that is it for today. Thanks for watching, and remember, every story has lessons waiting to be discovered. See you in the next video. Subscribe so you don't miss out. Bye-bye.